What's going on, guys? Welcome to day 2 of the option strategy guide. Today we're going to be talking about the Iron Condor. The Iron Condor, basically, once you have all 4 of these legs set up, what's basically going to happen is you are creating a range where you will be able to experience max profit. So the P&L chart's going to look something like this for the Iron Condor. Something like that. So this is basically when you're selling these two right here, uh, it's going to fall between. You're creating this range where you'll experience max profit. The if the price of the stock finishes between the price of this option right here, or the strike price of this option right here, and the strike price of this option right here, then you will be able to experience max profit. And then what these two legs are doing right here, basically, is they are making it so that instead of continuing to trend down as we get outside that range, we're just going to see a flattening out where we aren't losing money anymore. So let's go ahead and set this trade up. So first, Iron Condors work best with stocks that are trading kind of sideways. My recommendation for finding these stocks are basically just find stocks that have had big gains or big losses in the week prior, and then just look for consolidation after those big gains or big losses. So the stock that we're going to be doing this Iron Condor on today is SNDL, Sundial. And the reason we're doing that is because if we look on the daily chart here, we had this big up and big down, and then we've just had like a couple weeks of just consolidation in the $1 to $2 range. So looking at the technical analysis though, so we were in a downtrend from this $2 mark all the way down to this 90 cent mark, and then we start bouncing back up. This volume is very low compared to all this downtrend back here, so uh, that's bullish because even though the volume's low, the price is going up, which is exactly what you want. So moving on here, so if we think the price is going to go up this week from the $1.42 mark, we have established a top end of $2, right? And we've established a bottom of $1. So we could trade that range, but because we have a very wide strike price of $1 when the price of the stock is only $1.40, that's kind of cutting into our premiums. So remember, guys, the main legs are selling. We're selling two options, which means that we're receiving a net credit. So the the lower the gap between the two strikes that we sell these two options, the more money that we would receive. If this gap is super wide, our max profit is going to be very low. So just going into that, let's go into the option chain here. So let's say that we were to set up a Iron Condor between $1 and $2. So basically, we would have to sell. Well, first of all, we are buying a call, or we're selling a call above our projected price, and we're selling a put below our projected price. So let's just say that we're bullish on SNDL, and we think that the price is going to end around the $1.60 mark. So by next week, what we're saying is that we think that the price is going to be $1.60. But we also know that the price could go down. So like I said, if we sell this $1 put right here, all we're receiving is about $5. And then that also kind of puts us in a position where there isn't much insurance because we have to buy this 50 cent, which is extremely unlikely for it to ever actually protect us. So I'm gonna set this up a little riskier, where we're gonna be selling this in the money put right here at $1.50. So yeah, like we will technically be wrong if the price goes down, and but you got to remember that we already received this credit. So that credit is basically protecting us from downside, right? And this put is also protecting us from downside. But let's just start setting up this trade. So we're going to be selling a call and we're going to be selling a put. So we're selling a call above this price. So $2. We're going to be selling the $2 call because we think it's unlikely that the price will break $2 by the end of next week. One more thing to touch on, guys, before we keep moving forward. Iron condors tend to, from a technical standpoint, tend to work best on short timelines. You could, trade these, a month out or more and receive more premium. But the problem is that, like, especially with SNDL being a penny stock, the likelihood of it breaking penny stock status by the end of next week is very unlikely. It's very unlikely we're going to see a run to $5 unless it has this Wall Street bets stuff happen to it again, which is unlikely because it's already happened. But so moving on. So we sold this $2 call, right? So that is a net credit of $10 right there. That's a $10 credit. And then we're selling this put. Like I said, we don't really want to sell this $1 put because it's creating too big of a spread, right? So our net credit received, if we sold this $1 put, would only be $15. But if we sold this $1.50 because we do think it's going to go up, then we are receiving $30, 6 times the amount, just by moving this up right here. So we're receiving $30 right there for a net credit of $40. So we're being paid $40 to enter these two positions. So we're selling the $1.50, not the $1. So we're being paid $40 to enter this position. What this means is that on this P&L chart, right here is about 1.5, and right here is $2. As soon as this starts going down, this corner right here is 201. At 201, we start losing money, and at 149, we start losing money. Moving on to the insurance legs, so these legs down here, we're buying a call above the price that we sold it, and we're buying a put below the price that we sold a put. So we're buying this 250 call, and we're buying the $1 put. With stocks that cost more, you can kind of get creative. Like I said, we talked about the spread on the main legs, but you can also spread your insurance legs. But because the price of SNDL is so low, we kind of need to keep everything really, really tight because it's very unlikely for it to jump one way or the other, right? So entering into these two trades, the bid-ask spreads say the asking price is 0 for this 250, and the asking price, or the bid price for both of these options is 0. But it's very unlikely you're going to get a fill at 0. So the last price for both of these is $5. So we'll just assume that we're paying $5 for these. So we're paying $10, and this results in a net credit of $30. So $30 is our max gain if we were to open this trade with the current values. So that's our max gain right there. And then basically that means that if it falls between $1.50 and $2, then we realize this max gain. And once it starts breaking outside of that, we start to give back a little bit of that until we are losing money. But as soon as we hit this, let's change the color here. As soon as we hit the $1 mark right here, or $2.50 right here, then that's when it flattens out. That's why this is flattening out. But let's talk about the actual transaction that's going on with all 4 of these legs, because that's really important to understand, and important to understand why the chart looks like this, and how you can kind of protect yourself even further, right? So if we go into right here, so to protect yourself from upside, from breaking to the upside, what I recommend you guys to do is already own 100 shares. What this does is that if this $2 call that you sold, if you get exercised because the price of the stock is above $2, then whatever you are still profiting whatever you were able to. You're still profiting whatever you bought the 100 shares for. So let's say that you were to buy 100 shares for the current price of $1.42, and then you were able to sell them for $2 because the price ended above $2. Well, you still made 58 bucks. And you made $10 from selling the option. So really altogether you made 68 bucks. Even though you lost to the upside, right? Now that's not taking into account missed profits. So let's say this ran all the way up to 225, then you would have $25 of missed profits, which you can't really calculate into this because it's missed profits, it's not realized profits. You didn't lose money technically. You gained 68 bucks from this no matter what. No matter what the price ended at, you made 68 bucks. Now, if we when we bought this $1.50 or when we bought this 150 put, what that's saying is that we are agreeing to buy. No, so we sold this $1.50 put. And what we're agreeing to do is we're agreeing to buy 100 shares at $1.50. So if the so remember we received $30 in premium, right? So we had $30. Now that means that the price of uh, the stock could go down 30 cents below $1.50, and we would have still made money. So SNDL could go all the way down to 120, 1.2. Let's make that 2 a little prettier. 1.2. $0. And that will be our downside break even. So basically, as long as that's just for the put. So that's not counting this call that you sold because that call will still be in the money. But just for the put, it could go down to 120. Now, when you take into account this call that you bought, well, really, when you take into account the call that you sold and I keep misspeaking. I'm sorry, guys, but basically, these two up here are the options that you sold, and these two down here are the options that you bought. So we're talking. We've only talked about options that we've sold so far. So, doing the math, continuing on with the math, like I said, 120 is our break even, and then we received a $10 premium for this call that we sold, and that will remain in value. And then we received, or we paid $10 here as well. So we received $10 and we paid $10. So basically those cancel out, and as long as we end between 120 and 150, we will have still made money on this trade. Between 120 and 150, not including the shares that we own, we will have made money on this trade. Now, that is not taking into account this $1 put, which will have gained value. So, if this put were to go down to, we're not really going to talk about that because we are trading weeklies, right? So, trying to sell these options that you bought, I recommend that you guys don't do that because what you're really doing is you're removing your insurance, right? Like I said, if you already own 100 shares, you could go without buying this call. But what you're really doing is, if it does magically start ripping up, like it did before, then this call will start to get a lot of money, right? So you don't really want to miss out on that. And same thing with this put. You don't have to buy it, but it's insurance. And if it starts doing if the stock price starts doing something super unexpected, then this put is going to be worth a lot of money. This isn't taking into account IV changes, theta changes, anything like that. If it's Friday and it's looking like it's gonna finish between this range, and something crazy happened with IV, and you are green in these two positions, then by all means sell them. The probability of if the price is at $1.80 2 hours before expiration, the likelihood of it jumping 20 cents is very low. So, but moving along here. So we are completely protected to the upside because we own 100 shares, right? So basically, no matter what, if the price goes up, we will have made money because we own 100 shares. Now, if the price goes down, like I said, below 120, we will have lost money. But the second that it starts to go below this $1, this $1 put is going to start gaining a lot of value. But the problem is that because there's not much downside on this stock compared to other stocks, you can only go to zero. It's unlikely that this put is ever going to make you profitable. So basically, we are entering into a very bullish iron condor here because we are selling in the money put, which is why we're receiving so much money here. And then, we have downside protection with this put, but it's not much. It's not going to make the entire. It shouldn't. In my head, just doing quick math, it shouldn't make this entire trade profitable, ever, really, because the value of this option can only go up so much. Now, this call, on the other hand, if it were to go up all the way to $3 somehow, we'll just do some quick math. If the price of SNDL were to go up to $3, remember, we made $68 just from the movement up to $2, and then we're going to be missing out on about $50 while it goes all the way up to $250 because we aren't getting those shares anymore. Because now that the price is above $2, we cannot sell these, or else we would have to buy 100 more in order to sell just for $2. So we want to use the 100 shares that we have to sell at $2. So as it goes from 2 to 250, we're missing out on about $50 of profit. But as it goes up to $3, we are catching another $50 of profit. Now, you could look at this as, I'm going to let this expire, and I'm just going to, because he only paid $5 for this. Now, you could say, I'm going to let this expire, and I'm just going to sell it $3 and make a total of $45, because 50 cents times 100, that's $50. You paid $5 for this option. You're still going to be profiting $45. So yeah, we missed this $50 movement from 2 to 250, but we're still getting this 45 if it were to go all the way to 3, which, like I said, is unlikely. And then, yeah. So I guess that kind of wraps it up, guys. I kind of went through a lot. This last part especially, I'm sure, is going to be very confusing for some of you guys. If it's confusing, please leave a comment, guys. I'll be able to clear up anything. If I misspoke, if I said anything wrong, please let me know, guys. We'll be sure to retake this video and fix that up. But leave a like and a comment, guys. Like, comment, subscribe, all that stuff. It really helps the videos get pushed out to the channel, or pushed out to other viewers, and grow our Discord channel. We're trying to create a community of young investors and really the future of the stock market, guys. So thank you guys for watching, and have a good day.